Have you ever wondered who's actually making all those trades on Wall Street? I mean, you probably picture some stressed out guy in a suit yelling into a phone, right? But here's something that might shock you. Over 70% of all stock market trades in the United States aren't made by humans at all. They're made by computer algorithms, lines of code, mathematical formulas deciding where billions of dollars should go. And here's what nobody talks about. These aren't just simple programs clicking buy and sell buttons. We're talking about algorithms so fast they can execute thousands of trades in the time it takes you to blink. So sophisticated they can predict market movements before human traders even finish reading the news. So powerful, they've literally caused the stock market to crash in minutes. Here at Simple Money, we've spent time analyzing how technology is reshaping finance. And today, I'm going to reveal something most people completely miss. The stock market you think you know? It doesn't really exist anymore. It's been replaced by something entirely different. And whether you're investing for retirement, trading stocks, or just trying to understand why your portfolio moves the way it does, you need to understand what's really happening behind the scenes. Let me paint you a picture of what's really going on. Imagine you're at an auction, a really important auction. Maybe they're selling a rare painting or a valuable piece of real estate. Now, traditionally, how would this work? Someone would say a price. You'd have time to think about it. Maybe consult with your partner. Calculate if you can afford it. Then decide whether to bid higher. That's how stock markets used to work. Human traders would see a price. Think about it. Make a decision. Place an order. The whole process might take seconds or even minutes. And that felt fast. But here's what's really happening now. Imagine that same auction, but some bidders have a superpower. They can see every price change a full second before you do. They can place 10,000 bids in the time it takes you to raise your hand once. They can analyze every previous auction in history and calculate the perfect bid in microseconds. And they never get tired, never get emotional, never need lunch breaks. That's not an auction anymore. That's a completely different game. And you're playing against opponents who exist in a different dimension of time itself. This is the modern financial market. And most people have no idea it's happening. Here's the first thing you need to understand. What I call the speed barrier. Think about how fast you can react to something. Let's say you're driving and suddenly a ball rolls into the street. Your brain has to process what you're seeing. Recognize it's a ball. Realize a kid might run after it. Decide to hit the brakes. Send the signal to your foot. Actually press the pedal. Even in an emergency, that's taking you at least half a second, probably closer to a full second. Now let me blow your mind. High-frequency trading algorithms can analyze a stock price, make a decision, and execute a trade in less than 1/1,000,000th of a second. We're talking microseconds. Some of the fastest systems are now measuring their speed in nanoseconds. That's billionths of a second. Why does this matter? Because information in financial markets is everything. If you know something before someone else, even by a tiny fraction of time, you can profit from it. And we're not talking about insider information or anything illegal. We're talking about being faster at processing publicly available information. Here's a real example. Let's say a company announces earnings that are better than expected. That news becomes public at exactly 3 p.m. A human trader might see that news and think, "Oh, this is good news. I should buy the stock." They place their order maybe 5 seconds later. Seems fast, right? But in those 5 seconds, high-frequency trading algorithms have already read the announcement, analyzed whether it's good or bad news, compared it to hundreds of similar announcements in the past, calculated the probable price movement, and executed thousands of trades. By the time that human trader's order reaches the market, the price has already moved. The algorithms bought the stock when it was cheaper and are now selling it at a higher price. To you, the human trader thinks they're reacting to news, but they're actually arriving at a party that's already over. Here's what makes this even more insidious. These algorithms aren't just fast, they're everywhere. Some trading firms have literally paid millions of dollars to place their computer servers as physically close as possible to the stock exchange's servers. Because even the speed of light matters when you're operating in microseconds. They've spent hundreds of millions building private fiber optic cables in perfectly straight lines between cities because the shortest distance means the fastest connection. Think about that. Companies are reshaping geography itself just to be a few microseconds faster. The second thing you need to understand is what I call the prediction machine. Okay, so algorithms are fast, That's impressive, but maybe not that scary, right? Here's where things get really interesting. Modern trading algorithms don't just react faster than humans, they predict the future. Now, I'm not talking about crystal balls or magic. I'm talking about something much more powerful: machine learning. These are algorithms that can analyze millions of data points, find patterns that humans would never notice, and make predictions based on those patterns. Here's what most people don't realize. Every time you make a trade, you leave a fingerprint. Not literally, but in the data, the size of your order, the time you placed it, the price you're willing to pay, how quickly you modify your order, whether you're buying or selling other stocks at the same time. All of this creates a pattern. And here's the crazy part. These algorithms can read those patterns. They can figure out that when orders with certain characteristics appear, the price is probably going to move in a specific direction. They can detect when a big institutional investor is trying to quietly buy a large position, and they can trade ahead of that movement. Let me give you a concrete example. Imagine you're managing a pension fund and you need to buy $10 million worth of a particular stock. You can't just place one giant order because that would push the price up immediately. So you're smart about it. You break it into smaller orders. You spread them out over time. You try to be subtle, but here's what you don't realize. Your pattern of small orders, even though they look random to a human, is completely obvious to a machine learning algorithm that's analyzed millions of similar situations. The algorithm detects your pattern, realizes you're going to keep buying, and it starts buying just before your orders, pushing the price up slightly each time. Then it sells to you at that higher price, over and over. You never see what's happening. You just notice that somehow the price seems to move against you whenever you're trying to make a large purchase. You might think it's bad luck. It's not luck. It's math. The third reason is what I call the liquidity illusion. Now, you might be thinking, okay, but surely these algorithms do some good, right? And actually, yeah, the firms that run them will tell you they provide something called liquidity. Let me explain what that means. Liquidity is basically how easy it is to buy or sell something quickly without moving the price too much. If you want to sell your car, that might take weeks and you might have to negotiate on price. That's illiquid. If you want to sell $1 for 100 cents, you can do that instantly. That's liquid. Stock markets need liquidity. You need to know that when you want to sell your shares, there's someone ready to buy them at a fair price. And algorithmic traders do provide this. They're constantly offering to buy and sell, making it easier for everyone else to trade. Sounds good, right? Here's the problem. This liquidity is conditional. It's there when you don't really need it, but it vanishes exactly when you need it most. Think about it this way. Imagine you're at the beach and someone's offering free swimming lessons. Great! But here's the catch. They only offer lessons on calm, sunny days when the water is perfectly safe. The moment there's a storm or rough waves, they disappear. That's not really helping you learn to swim in the real world. That's what algorithmic liquidity is like. When markets are calm and orderly, these algorithms are happy to provide liquidity. They'll buy and sell all day long, making tiny profits on each trade. But the moment things get uncertain or scary, they shut off, instantly, because they're programmed to avoid risk. This is exactly what happened during the flash crash of 2010. On May 6th, the stock market dropped almost 10% in minutes, not hours, minutes, then recovered most of it just as quickly. During that time, many algorithmic traders simply stopped trading. They pulled their liquidity right when the market needed it most, which made the crash even worse. Here's what makes this particularly cruel. Regular investors, people with retirement accounts and college savings, they can't just shut off during scary times. They're stuck holding their investments through the chaos. But the algorithms that are supposedly making markets more efficient, they get to sit on the sidelines whenever things get tough. The fourth thing you need to understand is the fairness fracture. Let's talk about something kind of philosophical for a second. What makes a market fair? Most people would say a market is fair when everyone has access to the same information and the same opportunity to trade. When the game isn't rigged in favor of certain players, here's the uncomfortable truth. The modern financial market is fundamentally a two-tiered system. There's the game that algorithms play, and there's the game that humans play, and these are not the same game. If you're a regular investor, you access the market through your brokerage app or website. You see prices that are delayed by milliseconds or even seconds. You pay small fees on each trade. Your orders are routed through various intermediaries before reaching the exchange. This all seems normal because it's how it's always been for you. But high-frequency trading firms are playing an entirely different game. They have direct access to exchanges. They see price information microseconds before you do. They pay essentially nothing per trade because of volume discounts. They can place and cancel orders instantly without penalty. They get special order types that aren't even available to regular investors. Now, the firms that do this will tell you it's fair because anyone could theoretically build the same systems. But that's like saying Formula One racing is fair because anyone could theoretically build a race car. Technically true, practically meaningless. To compete with high-frequency trading firms, you'd need millions of dollars for technology infrastructure, direct connections to exchanges that cost hundreds of thousands per month, teams of elite programmers and mathematicians, constant upgrades to stay ahead of competitors. Oh, and you'd need to do this in an arms race where your competitors are also spending millions trying to be faster than you. For a regular person saving for retirement, you're not playing the same sport. You're not even in the same stadium. The fifth thing is what I call the cascade risk. All right, we've talked about speed, prediction, liquidity, and fairness. But here's maybe the scariest part: complexity. These algorithms don't exist in isolation. They're interacting with each other, constantly. And nobody fully understands what happens when thousands of complex algorithms all interact in unexpected ways. Think about it like this. Imagine you're in a room with one person and they make a sudden movement. You can react appropriately. Now imagine you're in a crowded subway car and one person makes a sudden movement. A few people near them react. Then people near those people react to the reaction. Within seconds, you could have a panic. Even if the original movement was harmless, someone just dropped their phone. That's what can happen in markets filled with algorithms. One algorithm detects something and starts selling. Other algorithms detect that selling and interpret it as a signal that something bad is happening. So they start selling too, which triggers more algorithms to sell. And suddenly you have a cascade where the market is plummeting and nobody even knows why it started. This isn't theoretical. It has happened. Multiple times. The flash crash I mentioned earlier? That was exactly this kind of cascade. More recently, there have been smaller incidents where individual stocks suddenly crashed by 50% or more in seconds, for no apparent reason, then recovered just as quickly. Here's what's really scary about this. The firms that build these algorithms test them extensively, but they test them in simulations. The real market contains thousands of other algorithms that those firms don't have access to and don't fully understand. It's like testing a new car by yourself on an empty track, then putting it on a highway with thousands of other experimental vehicles, each using different technology, each reacting to what all the others are doing. Nobody knows what will happen. We're running a massive experiment in real time with real money. Your retirement savings are part of that experiment. But here's what nobody wants to admit. And this is the deep dive moment. The really uncomfortable truth. All of this, everything I just described, isn't some unfortunate side effect of progress. It's not an accident that markets have become this way. This is the logical outcome of a system that prizes speed and efficiency above everything else. We built financial markets on a simple idea. Information should be reflected in prices as quickly as possible. That's market efficiency. It's supposed to be a good thing, because it means prices are more accurate, resources get allocated better, and markets function more smoothly. But here's what happened. We got exactly what we optimized for. We got speed, we got efficiency, and in the process, we created a market that's too fast for humans to understand, too complex for anyone to fully control, and too fragile to trust during the moments that matter most. Think about the irony here. These algorithms were created to make markets more efficient, and by some measures, they have. Spreads are tighter, meaning the difference between buying and selling prices is smaller. Trades execute faster. The market processes information more quickly. But efficiency for whom? If you're a high-frequency trading firm, you're capturing tiny profits millions of times per day. That's efficient for you. But if you're a regular investor, you're facing a market where the price moves before you can react, where liquidity disappears when you need it, and where sudden crashes can vaporize your savings in minutes. We've optimized the market for machines, not for people. Let me tell you about Marcus. Marcus is 42 years old. He works in marketing. He's been diligently investing in his retirement account for 15 years. Every month, he puts away money into index funds. He's doing everything the financial advice blogs tell you to do. Marcus checks his account maybe once a month. Usually things are pretty boring. Gradual growth. Sometimes it dips a bit. That's normal. He understands markets go up and down. But then one day, he happens to check his account right as a flash crash is happening. He sees his balance dropping. Fast. In the 3 minutes he's staring at his screen, his retirement savings drop by 8%. His heart is racing. He's reading news headlines trying to figure out what's happening. Is this the next financial crisis? Should he sell everything? Here's what Marcus doesn't realize. While he's panicking, trying to decide what to do, high-frequency trading algorithms are having a completely different experience. They're not panicking. They're not emotional. They detected the crash starting. Some of them immediately stopped trading to avoid losses. Others saw it as an opportunity and started buying, knowing the crash was likely temporary. By the time Marcus finally decides to sell out of fear, the algorithms have already bought at the bottom and are selling back to him at higher prices. Marcus doesn't know any of this. He just knows that somehow, every time there's volatility, he seems to be on the wrong side of it. He thinks maybe he's just bad at this. Maybe he doesn't have the discipline for investing. But it's not about discipline. Marcus is playing a game where he's fundamentally disadvantaged by the speed at which he can process information and react. Now, let me tell you about Jennifer. Jennifer is also 42, also works in marketing, also investing for retirement. But Jennifer has a different understanding of what's happening. Jennifer knows she can't compete with algorithms on speed. She knows she can't predict short-term market movements. She knows that trying to time the market or react to daily volatility is a losing game when you're competing against machines. So Jennifer doesn't try to play that game. She invests in low-cost index funds. She automates her contributions so they happen whether the market is up or down. She never checks her account during market hours. Maybe she glances at it once a quarter, just to make sure everything is still on track. When that same flash crash happens, Jennifer doesn't even know about it until days later when someone mentions it at work. Oh yeah, that happened? Huh. By the time she could have seen it, the market had already recovered. The whole incident is just a blip in her long-term investing journey. The difference between Marcus and Jennifer isn't intelligence or discipline, it's understanding. Jennifer understands that she's a human in a market increasingly dominated by machines. And she's structured her investing approach accordingly. Here's what most people don't realize. And this is the key insight that changes everything. The existence of high-frequency trading algorithms doesn't mean you can't invest successfully. It means you can invest successfully by trying to compete with them. The algorithms have won the game of speed and short-term prediction. That game is over for humans. But here's what the algorithms can't do. They can't decide what you actually need your money for. They can't determine your risk tolerance. They can't figure out whether you should be saving for retirement, or a house, or your kid's education. They can't make the human judgment calls about what actually matters in your life. The algorithms are playing a completely different game than you should be playing. They're trying to profit from tiny price movements over microseconds. You're trying to build wealth over decades. These are not the same objective. It's like being upset that a calculator can do arithmetic faster than you. Yeah, it can. So what? The calculator can't decide which math problems are worth solving. It can't determine what you should do with the answer. It can't make meaning out of numbers. That's what you bring to the table, not speed. Meaning, purpose, long-term thinking, the ability to ignore short-term noise and focus on what actually matters. Here's the reframe that changes everything. The speed and sophistication of trading algorithms isn't a threat to your financial success. It's irrelevant to your financial success, unless you make the mistake of trying to compete with them on their terms. The question isn't whether algorithms are making markets less fair. They probably are. The question is whether that unfairness actually affects your ability to achieve your financial goals. And for most people, with a long-term investing approach, it doesn't. Think about it. If you're investing consistently over 30 years, does it really matter if you paid a few cents more per share because an algorithm detected your order pattern? Those few cents are completely meaningless compared to the overall trajectory of your investment over decades. If you're staying invested through market cycles, does it matter that algorithms can cause temporary flash crashes? Not really, because you're not selling during those crashes anyway. The only way algorithmic trading actually hurts you is if you try to trade frequently, trying to time the market, trying to react to short-term movements. That's the game the algorithms dominate, so don't play that game. The algorithms, the speed, the complexity, the two-tiered market? These aren't character flaws in the system that you need to overcome through cleverness or skill. They're features of modern markets that you need to acknowledge and route around. You can't outspeed the algorithms. You can't outpredict the machine learning models. You can't outtrade the high-frequency systems. But you don't need to. You just need to understand that they exist, understand what game they're playing, and realize that your game is different. Your game is patience, consistency, long-term thinking, ignoring noise, staying the course. These are human advantages. These are things algorithms actually struggle with because they're designed to react instantly to new information. The question isn't whether you can compete with algorithms in the modern market. The question is whether you're wise enough to realize you don't need to. Whether you can resist the temptation to try to beat them at their own game. Whether you can focus on what actually matters for your financial life instead of what's happening in microseconds you can't even perceive. The market has changed. The technology is here to stay. The algorithms aren't going anywhere. In fact, they're only going to get faster and more sophisticated. But your strategy doesn't need to change, because you were never supposed to be day trading against supercomputers in the first place.